We're here because free speech is under attack. We're here because people are being convinced that socialism works. We're here because people are being judged guilty until proven innocent. We are fighting back with facts. This is not a safe zone, so buckle up, Buttercup. This is the raw, naked truth.
Welcome to the Raw Naked Truth. I'm your host, Eric Lopkin, and with me is Wallet Watch contributor and financial advisor, John Rocco. John, how you doing today?
I'm very good. How are you, Eric?
Doing all right.
Good. Great.
So the market's been absolutely crazy. Everybody's looking at things like interest rates and potential recessions, but let's look at what the market's doing. Are we in correction territory already?
Yeah, we're in correction territory. And in some respects, we were banging against bear market territory as in some areas of the markets, especially technology. And this is always an interesting question. You never know for sure. Are you just in a correction? Is this a short-term thing, or is this something that's going to go on for a long time? And I refer to an advisor that I followed many years ago, Marty Zweig. He was a very astute advisor. He did very well. And one of the things that he said was, don't fight the Fed. And what he meant was, if the Federal Reserve is being accommodative, which means that they're lowering interest rates and making it easy to borrow money and making cash available in the economy, that's always a good thing for the stock market. So if you see that happening, you should be participating in buying stocks, and you should expect the market to do pretty well, even though it's going to have its corrections and all of that stuff. The upward trend should remain intact. When the Federal Reserve starts to withdraw that support from the market and tighten interest rates, raise interest rates, and take money away from the consumer, those are the times when you start to see the market contract and the market go down. So what we've seen is an extreme situation where not only did we bring interest rates to zero for over a decade, we started via the pandemic, and even prior to that, but it exploded in the pandemic, where we actually gave the consumers and investors and businesses tons and tons of cash. And that cash found its way into the market and continued to drive an asset bubble in the market. And now suddenly and abruptly, we're seeing a reversal in that whole scheme of giving money away. And now they're starting to take it back. So they're raising interest rates, which again, Marty Zweig would say, well, that's not a good sign. If you're don't fight the Fed. And the other thing that's happening is that the Federal Reserve in other ways is taking money off of away from the consumer, and we're not seeing all these incentives of cash coming in. So right now we have a situation where there's still a ton of cash out there for the consumer, and they've hoarded a lot of cash because they haven't been flying and doing cruises and everything. So they have hoarded a lot of cash, and now they still have that money to spend. So you're still seeing a residual burn off of that cash, which is driving the economy and sort of ignoring interest rates and ignoring some of the issues. So that's really what's happening. So are we in a bear market? Well, to go on with Marty Zweig, basically you go through this period of time where investors are in denial. They've never seen a bear market in a long time, and they think this is a dip, and it very well could be, but they continue to buy into these dips until what happens is the dip ends up recovering, but not to the full level of where it was before. And then there's another pullback, which takes you down a little lower, and then another recovery, which takes you almost to the next height, and then another pullback, which brings you lower until finally the investors get discouraged, throwing the towel on the market, takes its final dive. And that's usually the end of the market, the end of the bear market, where the consumer is or the consumer or the small investor or the investors are really burnt out. We're not there yet, but we could be headed there. It's always difficult to see if we're heading in that direction or not. But the Fed taking money away is not a good sign in general for the markets.
Right. We know for a fact that the Fed is going to be raising interest rates. They've told us this, and they expect to raise them, fairly quickly. And from what I've heard, they're talking about half basis points rather than the quarter basis points they've used in the past. So with the interest rates going up that quickly, it's obviously going to put headwinds against the market. Again, as you said, people haven't seen a bear market in a long time. So are we, you said we're, sort of knocking at the door in different sectors. Are we heading into an overall bear market?
Yeah, that would drag us into an overall bear market. There's a couple of sectors that are performing, and because of the circumstances of the oil industry, they can continue to perform. One is obviously the oil market, the energy market. So that's a situation that where you could see the oil markets, energy stocks, your oil producing stocks, continue to be in a bull market. But of course, the pressure of high oil prices could drag the rest of the market into a bear market. And the other situation is because of the change in the complexion of the Russian invasion of the Ukraine and NATO and the buildup of defense, the defense market, military equipment, et cetera. You may see defense stocks like a Lockheed or Raytheon and those kinds of companies stand up much better and maybe even do very well in a situation where we may end up with a military buildup in the U.S. and around the world. So there could be sectors like defense and oil that could do very well, while the rest of the market, the technology, the banks, the rest of the market will be floundering and going down.
So even in an overall bear market, there can be, I don't want to say safe sectors, but safer sectors.
That's correct. You typically healthcare is a safer sector. That's usually considered what we call a defensive sector, not to be confused with defense stocks. But there are some sectors that usually will do better, but the complexion of the decline is never easy to predict. And there's one factor that you have to keep in mind, and that is that if you're a hedge fund, which means you're an institutional investor that borrows billions and billions of dollars, and your money starts going against you, and you've got to pay off those debts tomorrow, you're going to sell anything that you can get your hands on. And it doesn't matter if it's a healthcare stock, if it's an oil stock, or whatever it is, you got to sell anything you can to come up with that cash. So when you get into those situations where these institutional investors that are overextended get squeezed, they could really, that's where you have these market crashes. Okay. And that's where you see these big drops in the markets.
All right. Well, thanks for that information, John, and thanks for being here.
Okay, thank you. Have a great day.
And as always, I want to remind our listeners that before you make any financial decisions, check with your personal advisor, because everybody's situation is different. And that's the raw naked truth. You can hear every episode of The Raw Naked Truth at xvadio.com/podcasts, the Apple Podcasts app, Google Podcasts, Spotify, iHeartRadio, Stitcher, Amazon Music, Audible, and wherever you find podcasts. We'll see you next time.